Right now, everyone is asking the same question. Should I buy or should I wait? And the most common answer you hear is wait, the market is uncertain. But that answer is incomplete, because this is not a market where you either buy or you don't buy. In fact, this is a market where your position determines your outcome. We are in early phases of uncertainty. The outcome is not clear, the timeline is not clear, and the full impact is not visible yet. And in this phase, most people are default to one behavior. They freeze. The logic feels correct. If risk is unclear, then the risk must be high. But this is where most people get it wrong. In uncertain markets, risk does not increase equally. In fact, it gets redistributed. Some asset becomes more dangerous, another becomes mispriced opportunities. So the market doesn't move as one. In fact, it splits into two completely different realities. One side, you have high-risk positions, mid-market, oversupplied areas, weak developers, and buyers who enter within thin margin. In this segment, even a small pressure creates forced decisions. On the other side, you have opportunity, not because the market is strong, but because the behavior becomes unstable. And instability creates pricing gaps. So the real question is not, should I buy? The real question is, where does the mispricing appear in this phase? First, distressed resale. Buyers who enter 1 or 2 years ago and now facing pressure, liquidity pressure, payment pressure, or uncertainty. So they exit below true value. Second, prime, ready assets. Not because prices collapse, but because some owners need liquidity. And when liquidity becomes the priority, pricing becomes flexible. Third, top-tier developers. Not through public discounts, but through structure. Developers like Emaar or Dubai Holding, they adjust their terms quietly. Payment plan improve, fees become flexible, and all that done without damaging the long-term value. And at the same time, there are areas you should not touch. Oversupply segments, weak developer, and pure speculations. Because in uncertainty, these are the first to break. So this is not about timing the market. It's about matching the move to your position. And at this point, there is always one question. What if I buy now and the market goes lower? The answer to that question is simple. Yes, it can go lower. But this is the wrong question to ask, because in real markets, you do not optimize for perfect timing. In fact, you optimize for perfect positioning. For example, you look at owners who entered in 2007 and 2008, or even during 2019 and 2020. In short term, yes, prices moved against them, sometimes sharply, and sometimes for longer than expected. But over the mid and long term, those positions recovered and continued to compound. So the outcome was not determined by when they entered. In fact, it was determined by one thing, their ability to hold. Because markets don't reward timing. In fact, they reward survivability. There are only two outcomes. If you are stretched, short term, or dependent on a perfect condition, then buying now is a mistake. But on the other hand, if you are liquid, patient, and focused on quality, then being early is not a problem. Yes, you might leave some profit on the table, but this is not the objective. Because the objective is to secure a position that performs over time. So the rule is simple. If buying now creates pressure, wait. But if buying now creates strength, act. Because in early uncertainty, you don't chase growth, you acquire mispricing. And this is not a bad market. And this is not a good market. In fact, it's a selective market. And the difference is not in timing. Matter of fact, it's in positioning. And at Archilens, we don't chase the market. We understand it.